So here I have the CPI and the GDP year-over-year growth, and so what you can see here, if I zoom out back into like the 70s and 80s, you can see really when inflation drops significantly, GDP is negative. And what ultimately fixes the late 1970s and 1980s inflation is significantly lower GDP. You have a negative rate here, and it goes up, and then it stays down here for a little while, and then right during that time, you see CPI dropping, and it permanently drops and really gets it out of the inflationary time. And so really, you really have to see the GDP year over year go below zero if you want to have a permanent drop in CPI. And right now, we're not there. And so even if it does drop or get close to zero, that doesn't mean we're fully out of the inflationary period, especially if the Fed does decide to cut rates. And then what you see is you see the GDP go up and see CPI go back up. And that's the problem with the inflationary cycle, is that as soon as something eases, that money flows through the economy and it causes more inflation. That's why it's so vicious. But you can see why the Federal Reserve is trying to really restrict the financial conditions. Furthermore, we had a few reports come out this week. One of them was yesterday, which was the JOLTS, and it basically just showed that there are plenty of jobs. Let me pull it up here. There are plenty of job openings, and you can see the graph. I mean, it's really stuck in this little area. You saw a low, and then spikes back up, and it's just stuck. I mean, there's plenty of job openings, and then even the initial jobless claims that came out this morning. Let me pull those up. You can see again that. Let me go to the open graph here so you can get a better idea. You can see that it's low. I mean, it's still low. So what does this mean? You have plenty of job openings. Even if I pulled up the participation rate, it was low from last month. You just have a lot of job openings with not enough people to fill those jobs. Therefore, wages is going to have to go up. When wages go up, that money circulates back in the economy, which produces more inflation, higher growth. So all reasons why the Federal Reserve wants to keep rates high and is trying to restrict the financial conditions so inflation can actually, one, stable and come down. So why could this be a serious issue for the market? Well, take a look at the Fed funds rate, and you can see where the market thinks the federal fund rate is going to be. So you can see the rate hikes here, and then sometime in July, you can actually see rate cuts. And then by the end of the year, they're thinking it's going to be close to 4.5%. And if this goes higher, I don't know if maybe it goes up to 6. That's a real possibility, and it stays at 6. Or maybe it goes up to 5 and it stays at 5 all year long. And the market is projecting it to be closer to 4.5 by the end of the year. It's cutting rates. That's really going to put a jolt in the market to the downside, because higher interest rates are going to be there. Financial conditions will be worse. You probably have lower maybe not lower revenues, but lower profits for sure. And so this could be real negative on the market, and right now the market's not pricing it in. So this is the number one main driver that I'm looking at as far as how to position my portfolio going into 2023. The next factor I'm looking at is potential war between China and Taiwan. And obviously this is something you can't really predict. It's very hard to predict. But I think when you saw Russia attack Ukraine, and there were some very obvious signs that they were getting ready to attack Ukraine, you're starting to see, you've been seeing the same signs with China and Taiwan. And this report came out this morning. China warns U.S. not to cross red line on Taiwan. I know there are a lot of very smart people, much smarter than me, that believe that China will attack Taiwan in 2023. I know a lot of these people were predicting this in 2022, and maybe they do, maybe they don't. I do not know, but this is something that will obviously affect the markets. And when Russia attacked Ukraine, you saw a bunch of people running into bonds at first, and so you actually saw bond prices go down. But then those people started unloading and started investing in other areas. So you saw it for a short period of time. Obviously, you saw oil spike up due to bans on Russian oil. China, I think you probably see something similar. China is a huge exporter of semiconductors. So how does that affect the semiconductor industry? We'll see. But another thing is the U.S. supplies a lot of military weapons to Taiwan. So very similar to last year when you saw, Lockheed Martin and other defense manufacturers, their prices jumped up, definitely right after Russia attacked Ukraine. But really, they stayed high through the whole year, and a lot of them ended up at the end of the year at the highs of the year right there at the end in December. So this is something that I think is at least people need to consider when they're thinking about 2023. With these items in mind and setting the backdrop for 2023, let's talk about how I plan on setting up my portfolio. And the first thing I want to do is be safe, be conservative. 2023 seems a lot different than 2022. In 2022, I was taking pretty large positions in shorts on bonds and technology stocks. This year, I'm not as confident on exactly what the Federal Reserve is going to do, and the market will swing on a dime with just a sentence from anybody that's on the board of the Federal Reserve. You'll see the market jump or drop. And so, even though the Federal Reserve is saying that they're planning on keep rates high through 2023. This is also the same Federal Reserve that said, inflation was transitory. And then obviously last year, you see multiple rate hikes as inflation spiraled out of control. So, you have to think about what they say and trust it a little bit, but not too much. So with that said, the first thing I plan on putting a large chunk of my money into is Treasury bills. And Treasury bills are not super sexy. They're not super fun. But a lot of times the people who say Treasury bills aren't sexy, I'm sure those people would like to have earned 4% last year compared to whatever they lost. And when you can invest into a 2-3 month Treasury bill and then end up with 4% at the end of the year, that's pretty good when you don't know where the market's going and there's a lot of negative signs. So I plan on putting a large chunk of my portfolio in Treasury bills. The next thing is I'm planning on putting money in definitely value stocks. I think value stocks are going to outperform growth stocks. So when you actually pull up the performance charts, you can actually see. Let me get it to last year, but you can actually see how well value outperformed growth. So, value came in roughly around 2.2% negative, and then growth, down almost 35% last year. I think you're going to see this continue into 2023, where value is going to outperform growth. Obviously, a lot of these value stocks are paying dividends, which is yielding some type of income for your portfolio. If we get into July and inflation has come down, and then you hear talks of the Federal Reserve cutting rates, then we'll readjust there, because obviously you'll see these growth stocks start to take off again. Another area that I definitely want to have a small bit of my investments in is these defense manufacturing companies. So Northrop Grumman was one I was invested in last year. You can see on the chart, I mean, it's got a nice little uptrend going here. So this is something that I want to, have some part of my portfolio in, as well as Lockheed Martin is another. one, obviously, as long as Russia is attacking Ukraine, you know, U.S. is going to be supplying military aid to Ukraine, which is great for these companies. But if China does attack Taiwan, I imagine you're going to see military supplies increase to Taiwan, as they already have, which is, again, great for these companies. So, and if China does attack Taiwan, most likely you're going to see a reaction in these stock prices, just like you did when Russia attacked Ukraine, and you see people rush into these companies. So, and my portfolio, I think, is a good idea to have a small percentage in these companies for anything that could happen as far as potential war or even continuation of war. I've talked about Activision for a while. This is another company that I'll be looking at, basically stay in the portfolio. Microsoft is planning on buying them out at the offer price of $94, I believe it is. Can't remember off the top of my head. But you're talking about right now it's sitting at roughly 77. So you're talking about potentially a 30% increase in price, maybe about 25% increase in price. So still, that's great. We just need the deal to get finalized, and you'll see the stock price shoot up. So again, keeping a small position in Activision as well. A couple of other things that I plan on having my portfolio is going short on Bitcoin. Bitcoin has obviously fallen a good bit since last year, and with the demise of FTX, it just seems like anything that comes out about Bitcoin is negative. Really, anything about crypto, I should say, is negative these days. And I think when you have restrictive financial conditions and maybe the economy starts to restrict, I think you're going to see people fleeing positions, sectors that are non-yielding. And obviously, Bitcoin is non-yielding, and you saw people flee it last year. And I think you'll continue to see people flee until essentially financial conditions start to ease, and you see the Federal Reserve cutting rates. Maybe you'll see people rush back into Bitcoin. But right now, with all the headlines that comes out about cryptocurrencies, it's just the wild, wild west. And I think it's catching up to them when there's not a whole lot of regulation. And, obviously FTX is the obvious one, but I mean, just this morning, read Coinbase got hit with a $100 million fine. So it just seems that this whole sector is somewhat toxic with the headlines that's coming out. But nonetheless, even if the headlines weren't coming out, I don't love it because it's non-yielding. It's very much speculative. And as money dries up, speculative circulation seems to decrease because people don't have the money to speculate with. The next area I am looking to short is junk bonds. So I was just, again, a follow-up from last year, shorting junk bonds throughout the whole year last year. But to me, this is somewhat of a conservative play because I don't think this will swing too far to the upside. I guess I think it's limited to the upside, which is why I'm willing to take a short position into this year. But as rates keep going up, you would expect to see the junk bonds come down, especially if the Fed raises rates more than the market's expecting, or they keep them high longer than they're expecting. Again, you would expect to see this come down. But if the U.S. does enter into a recession and GDP starts to fall greatly, you would expect, again, junk bonds to come down because you have these companies that are issuing these high yielding bonds, low grade bonds, and you would think people would want to be more conservative and rush into more investment grade bonds. So again, follow up from last year, just keeping this short in the portfolio. A couple other items, I shorted ARK last year, a good chunk of last year, and then covered and then reshorted sometime in October. It has fallen since then. Right now I don't have a short in ARK. I do still like the idea of shorting overvalued technology stocks, but a lot of these stocks have fallen so much. If this just kind of rebounds for some off the wall reason, or rebounds because people are just covering, and it really kind of rebounds for no reason, then maybe I'll look to take a position in ARK or some other technology stocks. It's funny because talking about Tesla is another one that I shorted last year, and Tesla has fallen so much since really December. My goodness, look at that sell off. I guess it started falling. When was that? Yeah, really throughout December 1st, it started falling so much. I remember reading reports back in 2019, 2020, 2021, saying Tesla's valuation, even though it had gone up 80%, 90%, it was the valuation is still too low. And now I think I read a report earlier this week saying even though it has a significant drop, it's still way above its actual intrinsic value. So it's funny how the story has kind of flipped on Tesla there. The last thing that I will mention is this isn't necessarily a long-term hold, but I am currently shorting Eli Lilly. You can kind of see the chart here had this nice upward trend. It finally broke below it, and you see a head and shoulders pattern, as well as the relative strength index. You can see how this is going lower. If I were to put an arrow on this, I can see back here, you can actually see it starting to drop lower. So all indications that Eli, quote unquote, should be dropping. Plus you have a gap to fill here about 311, 310. And with the overall market dropping from the jobless claims, the JOLTS number, the minutes from the Fed, I think there could be a good indication that Eli Lilly will drop. Now, Eli Lilly was a great performer last year. It was definitely up about 39% last year. So that's why I just mentioned it. This is not a long-term investment for me or anything like that, but just something that I'm currently shorting. So we'll see how this turns out. But that's it for 2023. Again, probably will look to readjust maybe in 4 to 6 months, depending on what the market's doing with the economy looks like, and the Federal Reserve is saying it should be an interesting year this year. And at least for me, the name of the game is try to be conservative and try to invest, obviously, in the the highest probability items will happen. I mean, I think most people say that, but also invest in things that are yielding. I think that's very important. I don't think 2023 is made for a year for people to have 30% returns, whether if they're shorting or going long. So I just think you take what the market gives you, you say thanks, and then get ready for the next year. Or if the Federal Reserve decides they're going to cut rates multiple times, then maybe we start loading up on certain stocks then. But that's it for now. Best of luck.